Hi everyone, welcome back to Corporate Decoder, the place where we uncover the truth behind corporate filings. And let me tell you, Sutro Biopharma's latest report has some interesting twists and turns that sound like a dramatic medical drama. So Sutro Biopharma, an oncology company working with cutting-edge cancer drugs, just dropped their quarterly report. And spoiler alert, it's not all sunshine and roses, but there's definitely a story in here about strategic shifts, financial maneuvering, and a company fighting to stay listed. Let's dive right into the numbers for the quarter ending June 30, 2025. First, the balance sheet. This is like the company's snapshot of what it owns and what it owes. A big number here is their cash and cash equivalents, which stood at around $64 million. Now that might sound like a lot, but compare it to $190 million at the end of the previous year, and you see a pretty significant drop, almost a 2/3 decrease. Their marketable securities also saw a bit of a dip, going from on 26 million to about 14.1 million, but that rise is actually a good sign for their short-term investments. To what really jumps out is their liabilities are sitting at a hefty $24 million for June 2025, up from $342 million at the end of last year. That's actually a decrease in liabilities, which is positive. But more importantly, look at their total stockholders deficit. Yes, you heard that right. They are in a deficit of over $32 million at the end of last year. That's actually a decrease in liabilities, which is positive. But more importantly, look at their total stockholders deficit. Yes, you heard that right. They are in a deficit of over 32 in liabilities, which is positive, but more importantly, look at their total stockholders deficit. Yes, you heard that right. They are in a deficit of over $32 million. That means their company is technically worth less than what it owes to others at this moment. Big yikes. Now let's switch gears to the statement of operations, where we see how much money they made and spent. Revenue is up significantly compared to last year. For the 3 months ending June 30, 2025, they brought in over $63 million, a huge jump from about $25 million in the same period last year. That's $148 million in the same period last year. That's $148 million in the same period last year. So it's in a similar story, with revenue soaring from $38 million yen. This surge month period also shows a similar story, with revenue soaring from $38 million last year to over $81 million this year. This surge is largely thanks to their Ipsen agreement, which we'll get to later, and a significant chunk of revenue was actually from derecognizing deferred revenue after Ipsen decided to stop developing one of their programs. But here's where it gets interesting. Despite the revenue jump, their operating expenses are still high. Research and development expenses, a major cost for any biotech company, dropped from $62 million to $38 million for the 6-month period. This is a direct result of their restructuring plan. And speaking of restructuring, they've recorded over $18 million in restructuring costs for the quarter and nearly $40 million for the 6-month period. This is for things like cutting jobs, winding down certain programs like Lupta, and terminating contracts. It's a tough but necessary move to manage their spending. Because of these massive restructuring costs, even with the revenue boost, they still ended up with a loss from operations of over $3 million for the quarter. But that's a massive improvement from a loss of nearly $49 million in the same period last year. So operations are improving, but the restructuring costs are a big hit right now. Overall, their net loss for the quarter was about $11.5 million. That's much better than the $48 million loss in the same quarter last year. The 6-month net loss also improved significantly from over $106 million last year to $87.5 million this year. So fewer losses are good, but they're still losing money. The statement of comprehensive loss shows the same net loss, but also includes other items that affect equity, like unrealized gains or losses on investments. For Sutro, the main number here is their net loss, which mirrors what we saw in the income statement. They also had a small unrealized loss on their investments, pretty much keeping their comprehensive loss in line with their net loss. This table is pretty stark. It shows that by June 30, 2025, Sutro Biopharma has a total stockholders deficit of over $32 million. This is a huge swing from the end of last year when they had a positive stockholders equity of over $44 million. This is a huge swing from the end of last year when they had a positive stockholders equity of over $44 million. This deficit is primarily driven by their accumulated deficit, which is now a whopping $874 million. That means they have accumulated a lot of losses over time. The net loss for the 6 months ending June 30, 2025 was $75.9 million, which they subtract from their equity. They also issued new shares of common stock, mainly through employee stock purchase plans and the vesting of restricted stock units. Interestingly, they also had a stock transaction related to taxes withheld on restricted stock units, which reduced their additional paid-in capital. Their additional paid-in capital, which is essentially money received from selling stock above its par value, grew a bit, showing they continue to issue stock. Let's look at the cash flow statement. This tells us where the cash is coming from and going. The most important part for most people is the cash used in operating activities. Sutro used over $112 million in cash for its operations in the first 6 months of 2020-25. That's nearly double the $55 million used in the same period last year. This increase is mainly due to the restructuring costs we've already talked about, cutting jobs and winding down programs. Investing activities used about $13.7 million, mainly for purchases of marketable securities, but offset by the maturity and sale of some of those securities. Financing activities shows very little cash flow, just $6 for the first half of 2025. This is a massive drop from $93 million provided by financing activities in the same period last year, which was mainly due to stock offerings. Basically, they're not raising much new money from financing right now. The net result is a pretty big decrease in their overall cash equivalents, and restricted cash, dropping by over $126 million this period. Now let's get into the nitty-gritty details within the notes. These explain the numbers you see in the financial statements. Sutro announced a restructuring plan in March 2025. This involves focusing on their three main drug candidates, D-Prior-TOL02 or Luvelta, and cutting their workforce by about 50%. They're also planning to exit their internal manufacturing facility by year end. This is a major strategic pivot to cut costs and extend their cash runway. On the liquidity front, the company states they have enough cash to operate for at least 12 months with about $205 million in unrestricted cash equivalents, and marketable securities as of June 30, 2025. However, they clearly state they will need to raise more capital. Here's a critical risk factor. They received a notice from Nasdaq that their stock price isn't meeting the minimum bid price requirement of $1. They have until December 17, 2025 to get back above that dollar mark for 10 consecutive business days, or they could be delisted. They might even consider a reverse stock split to fix this, which they have shareholder approval for. They operate under strict revenue recognition rules, accounting for money from partnerships over time as they fulfill their obligations, like licensing their drug technology. Their deal with Accession Pharma is a big one. They received a $90 million upfront payment, and revenue is recognized over about 4 years as they deliver services. There have been contract modifications due to Astellas not proceeding with a third target program, which impacted revenue recognition, and they also earned a $7.5 million contingent payment. The Ipsen deal is also significant. They received a $50 million upfront payment, and Ipsen also bought stock in Sutro. However, Ipsen recently decided not to advance the STRO-03 program. This has led to a big revenue recognition event for Sutro in this quarter, where a substantial portion of deferred revenue from Ipsen was recognized because the contract scope changed. A really interesting financial item is their deferred royalty obligation related to the sale of future royalties from their Vaxide partnership to Blackstone. They received $440 million upfront and recognized it as imputed debt. They incur non-cash interest expense on this obligation, which is about $9.7 million for the quarter. This is a complex financing arrangement that will impact future financials. The restructuring costs are broken down here, showing significant expenses for clinical trials related to deprioritized programs, severance pay, and contract terminations. It's clear the company is making some major cuts. Looking at their equity section, the number of outstanding shares of common stock has increased from about 82.5 million at the end of last year to over 84.7 million by June 30, 2025, reflecting stock issuances from employee plans and other transactions. They are spending a considerable amount on stock-based compensation, over $5 million for the quarter and over $10 million for the 6-month period. This is typical for biotech, but it's a significant non-cash expense impacting their equity. And finally, the net loss per share. For the quarter, it's a loss of 14 cents per share, much better than the 59 cents loss per share in last year's quarter. For the 6-month period, the loss is over $1 per share, again an improvement from last year's loss of almost $1.50 per share. Let's summarize the financial performance. Revenue is up a massive 148% for the quarter, thanks to those big partnership deals, especially with Ipsen and Astellas. However, operating expenses are down 10% overall, mainly because R&D costs are lower. This is driven by the restructuring. The restructuring costs of $18.4 million for the quarter really hit their operational loss, but the underlying operational loss, excluding these costs, would be much smaller. The loss from operations improved drastically, down 93% to just over $3 million. Interest income is down, which is expected as their cash and investment balances have decreased. The unrealized gain on equity securities is zero this quarter, compared to nearly $5 million last year. This is because they sold their remaining Vaxcyte stock. The non-cash interest expense on their deferred royalty obligation from the Vaxcyte sale increased to nearly $10 million for the quarter, reflecting the accounting for that complex deal. On liquidity, they believe they have enough cash for another 12 months, but they absolutely need more funding. This is a recurring theme, great science, but the capital-intensive nature of biotech means they are always on the hunt for more money. And they might try equity offerings, debt, or more collaborations, but raising capital is never guaranteed, and failure means they might have to cut programs or even shut down. Let's talk about the risks. There are a ton of them. They're dependent on their product candidates, STR-004 and STR-004 and STR-006 succeeding, and these are still in early development. Intellectual property is crucial, and protecting it is a constant battle that costs a lot of money and time. They also face the risk of not meeting their development timelines, which would directly impact their stock price. Their core technology, the XPrey-CF platform, is novel and unproven, which is a high-risk, high-reward scenario. And of course, the Nasdaq listing issue is a huge immediate risk. If they can't get their stock price back up above $1, they face delisting, which would be a major blow. They also warned that their stock price could be very volatile due to a mix of good and bad news and investor expectations. So what's the verdict on Sutro Biopharma? Sutro is in a classic biotech tightrope walk. They have impressive revenue growth fueled by smart partnerships, especially with the Ipsen deal recognizing deferred revenue, which is a nice financial boost in the short term. Their operational efficiency seems to be improving, as shown by the reduced operating expenses and narrow loss from operations, even with the heavy restructuring costs. That, however, the significant drop in cash reserves and the stark stockholders deficit are real warning signs they're burning through cash to develop these complex drugs, and the need for more funding is critical, the restructuring costs. And however, the significant drop in cash reserves and the stark stockholders deficit are real warning signs. They're burning through cash to develop these complex drugs, and the need for more funding is critical. The looming Nasdaq delisting is also an immediate threat that needs serious attention. They're relying heavily on their novel technology platforms, which, while potentially revolutionary, also carry inherent risks because they are unproven, fall strategically the restructuring to focus on key preclinical. In essence, Sutro Biopharma is a company with high risk, high reward potential. The science behind their novel drug conjugates is compelling, and the revenue growth is strong testimony to the value of their collaboration agreements. But the path ahead is fraught with financial and operational challenges. They need to execute flawlessly on their development pipeline, manage their cash very carefully, and navigate the critical Nasdaq listing requirement. Alright, that's our deep dive into Sutro Biopharma's latest filing. What do you think about their strategy and the risks they're facing? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate insights. And don't forget to join our Discord community linked in the description for more unfiltered discussions. Thanks for watching, and we'll see you in the next video.